And Alan is asking, I have a pre-approval from my lender and we're trying to buy a home within the next month. How long is my interest rate good for? So this is like locking in rate type of a question.
Well,
this is
Can you lock in right now?
This is like you don't have a rate.
Right.
Really? You can't lock rates right now?
Now, if you don't have a property.
Yeah, until you're in contract.
Until you're in contract, you can't lock a rate.
No.
Correct.
So his pre-approval is a credit approval, which means that his income and his assets qualify him for a certain amount of money based on the rates that day or depending on how conservative the lender. Now, if the lender pre-qualified him at 5% interest rate, he's totally cool. Yeah. He doesn't have anything to worry about. But if they qualified him at the interest rates that a month ago or 2 months ago or a week ago, he's going to, because it will affect even Friday, it will affect the maximum amount that they qualify for, which is a totally different topic about shopping for how much you qualify for, which you shouldn't do.
So right now, it's almost better to be qualified for a higher rate than we're seeing. Yes.
What I'm going to say, if you're looking right now and you've been pre-approved, make sure that your loan officer has pre-approved you. I would say at least a quarter higher than where you're at. That way you have yourself a buffer in the event that it does go up. I was going to say at least.
So qualify at 5.
Right now, I have everybody at a half. A little bit of half over, depending on their specific situation.
Right.
But just to be on the safe side, at least a quarter. If you want to be conservative, I would say a half. That way you protect yourselves from any sort of vulnerabilities if the rates do spike up again.
That sounds like the nugget right there.
And that really should be something that you should be doing anyways. Like I always did it at a quarter. Now I've done a little bit higher because we've seen such instability lately that you really just need to.
The more volatility, the more conservative you need.
So basically, since these videos are, forever, I mean, we don't know, in the year 2025, someone might see this video on YouTube. Basically, when the market is inching up, you want to overqualify.
Correct.
And when it's going
when
down,
you're seeing instability,
you should almost always overqualiify. And is
that something you guys do all the time? You overqualify?
I always do. Yeah. When it was more stable before, basically June, I always did it a quarter above.
Right.
And the other thing that you want to do is, especially, and a lot of clients are doing this right now, if you're looking at your very max, you really need to put your half buffer in there. 0.5% buffer, because a lot of people are saying, big difference what's the most I can do on this house?
Well, and one of the challenges is that an inexperienced loan officer may qualify you for something that you really don't qualify for, or put you in a position of vulnerability where they're not going to be able to deliver. So if you've got somebody who doesn't have the experience or the nerve to compete with you on their knowledge of the market and their experience, and they're just trying to be the low rate leader, the low price leader, they could give you an interest rate that's not really. Maybe it was available, maybe it is available today, but they're really not giving you any sort of security or any sort of cushion. No just in case.
I mean,
it's harder to sell a higher interest rate for somebody that says, I want the lowest interest rate because I heard a radio commercial yesterday that said I can have this, but Elisa's given them an interest rate higher.
I know I've absolutely lost deals because of that, but it's in the interest of.
But people have lost houses because of that,
which is the hard part.
Frank, that's not the standard in the industry, is it? Because
I was going to ask you, when you're not using Elisa for your LO, loan officer, do you see other loan officers doing that? Because I've been around a while now, and I don't really remember somebody telling me that.
If they were, it was probably something I didn't recognize because it didn't come up. It didn't become an issue.
Right.
But I've seen where I've had a buyer that has already had that lender. They're not going to go anywhere else, and they're displeased in the end because their rate was a little higher than they were expecting. Their payment was a little higher, obviously, because of the rate.
Right.
So no, but that's the perfect way to do things. It's the equivalent of when I take a buyer out and have them look for property less than their maximum purchase power.
So you have room to negotiate.
Yeah, room. You need a cushion.
Cool. I like it, man. Those are good questions. Thanks for sending those in, guys.